Hey, it's Mr. Blake, and this is my video for the international development section of the development, is specifically banking and how banking interacts with the developing world. Big key points I want to stress to try to keep this short for you guys, I guess, is one thing you have to think about when it comes to banking and international finance is that most of your world's big banks are in developed countries. So the United States, Great Britain, France, China, Japan, and so forth. And so if you are looking at who's doing the banking, it is probably an MDC or a more developed country where those banks are located. So if you are a developing country and you're trying to get a loan from one of these private banks, that's who you're going to go to is the Ecomene countries, the developed countries. And the problem is for most developing countries is they are considered poor risk by these banks. Unless you have some sort of resource that people want in abundance, let's say oil, probably a lot of these banks are not going to be willing to give you the time of day. And so you're probably going to have to go to some other organization to get development money, to build your infrastructure, to build your industries, and that sort of thing. And that is when most people, most countries would then turn to the World Bank. The World Bank was created after World War II as part of the United Nations. It has two key divisions within it that do sort of banking stuff. The first, and I had to write it down because I never can remember this one, is the IBRD, which is the International Bank of Reconstruction and Development. And that one was specifically set up to help war-torn countries after World War II to restore their economies. So it was really set up for places like Germany and Japan and Italy to help restore their economies. And if you were considered a developing country at the time, right around the 1940s or so, into the 1950s, you might be able to get development money from this particular agency as well. That was mostly Latin American countries because they were already independent back in the 1800s. So they had sort of a track record of being a country for a while. And so they could get loans from this particular group. Now, why would you go to this agency to get money? Again, think about these countries. These are poor countries. They're trying to develop their infrastructure. So what you're probably taking out your loans for are things like developing your port, maybe building an airport, building roads, building schools, hospitals, clean water systems, installing sewage systems, all the basic infrastructure that you would need if you were going to become a developing country with lots of industry moving in. You need to have that infrastructure in place first. Now, these were for established countries. There was a second agency set up, which is the IDA, it's the International Development Agency, and this handled what were more considered credit risky countries. Most of these would have been Asian countries or sub-Saharan African countries that got their independence in the 1950s and 60s because originally they had been colonies in the 20th century. But because they had no real background as far as being an independent country, their governments were often unstable, their economics was often unstable. These were considered bad risk. And so the IDA would handle those kind of countries. They would loan you money, but at considerably higher interest. And again, with all of these, you're having to repay the loans. So whatever it was that you took the loan out for plus interest. So many countries did this. They went and got loans from these particular organizations, billions upon billions upon billions of dollars. And sometimes it works great, and sometimes it doesn't. And in many cases, it didn't. That whatever that they got the loan money for did not turn their economy around and make it grow the way that perhaps they had wanted it to. And so often what would happen then is they would take more loans out and try to use that money to pay off some of the previous loan money, plus have a little extra to spend on things. And when that didn't work out, you take out another loan to try to pay off that earlier stuff. And you're getting deeper and deeper and deeper in debt because every time you take out another loan, it's going to be for more money at a higher interest rate. And eventually, a country ends up in the position that it can't really pay any of this back. They're just too deep in debt. And that is when another organization steps in, and that is the IMF, the International Monetary Fund, which actually does not do banking per se. They are not there to issue loans to countries. They are there to collect the money that these countries owe. They are also part of the UN. They're part of that World Bank organization. And when you are dealing with the IMF, a couple of things have probably happened. They're going to negotiate with you and whoever it is that you owe money to try to find out some way to where you can get back to making payments on your debt and stuff. Sometimes they will take on some of that debt from some creditor, some private bank, or maybe from the World Bank itself. But a lot of times they are there to reorganize your economic system to make sure that you have money coming into the Treasury, and then that Treasury money is used to pay your debts. The IMF is not particularly popular in especially the developing world because they tend to have financially rather strong arm tactics. They will take over anything in the country that may generate revenue, money. So often they will take over the postal system. They'll take over the ports because there's port fees that ships have to pay, and so they want that money. Often they will require the country to cut back on its civil service. So government employees are cut down to really next to nothing. A lot of people end up unemployed because they were government employees and they're trying to cut the payroll for the government. If there is land owned by that government, often they are required to sell that land to private interests to raise money, and so forth. And so the IMF are kind of enforcers. If you think of it in sort of that mafioso way, that they're the guys that come and tell you you pay up or we break your kneecaps. And that's really kind of the reputation the IMF has around the world. Now, what they're supposed to be doing is helping countries get their economics under control to where they can repay their debt. They're supposed to be doing it in some ways like you have to cut your defense spending, to the bone. You don't need to be buying all that stuff. You need to be using that money to pay off debts and invest in things that are going to grow your economy. One of the things that you're supposed to invest in is education, because the more educated your population is, the more jobs they can do. That can then attract the businesses coming into your country to do business in your country. And with all those new paychecks that they're getting, that means more money circulating in your country. And theoretically, your economy should be growing then, and it makes it easier to pay back those debts. The reality is that often this does not happen, that they are more interested in cutting government spending in all the various ways that you might have government spending to the bone, and using all of the revenue that the country's generating to pay back debt, which makes them, again, very unpopular in the world that owes the World Bank money or private banks money. So keep that in mind. What I was describing is what we would call an austerity program. Austerity means cutting government spending to as low a possible amount as possible. So again, firing government employees. Those that stay around, you're going to cut their paychecks in half. Retirement pensions to retirees get cut. Just about anything that you could think of that would cost the government money, they are going to require you to cut back on, which makes it very unpopular in the countries that happens. What they should probably be doing is what we would call a stimulus strategy, where you are going to encourage that country to remove payment of funds for things that are not really helping the economy grow, and reallocate those funds into things that would help the country grow. So upgrading the electrical system, for instance, or schools so you can educate your population. Things that would make it easier for businesses to then move into your country, grow the economy altogether, and then again make it a little easier to pay off your debts. So again, those are two strategies: the austerity strategy, cut expenses as much as possible and use the money saved to pay off debt. Or you can go with the stimulus strategy, which is try to stimulate the economy with some infrastructure spending to make you a more desirable country for businesses to move into that country. So those are the two. That pretty much summed up everybody or everything today. So I hope you enjoy this TED Talk about international banking.